In my last video, I talked about 3 dividend stocks that investors could hold forever. Although the list I made is good and you should still watch that video if you haven't, the companies I talked about in that video had relatively lower yields. This means for investors who may be a bit older or who just want a little bit more passive income, they weren't the most viable picks. That is why in this video, I have compiled a short list of 3 dividend stocks with yields over 5% that you can buy now and hold forever. These stocks won't be immune to market conditions per se, but they have proven that they can weather tough times in the market, making them reliable picks for income-oriented investors who don't want to be constantly worried about share depreciation. Before we start this video, make sure to like and subscribe if you're new to the channel because I will be posting dividend stock videos just like this one every few days. The first stock on this list is Ares Capital Corp, ticker ARCC. Ares Capital is a business development company, more commonly known as a BDC. A BDC is a company that invests in small and medium-sized companies, helping fledgling companies gain some financial footing. BDCs in general can sometimes be riskier investments as they often invest in distressed companies or use heavy leverage, but Ares Capital has plenty of liquidity and an extremely strong balance sheet, making them one of the best BDCs investors can get their hands on. The company currently yields just around 10% and trades at a P/E ratio of about 12. The dividend history of this stock is solid and it has consistently yielded anywhere from 38 to 51 cents a quarter for the past decade. Although the dividend growth isn't consistent, it's still there as their dividend has inched forward over time. The reason the dividend yield is so high is because as a BDC, Ares Capital legally has to pay 90% of their profits to shareholders, which is the same rule that applies to REITs. Over the past 5 years, the company has appreciated in price by 11%, but if you factor in the dividend as well, the stock has been able to keep up with the market while also supplying income investors with cash if they need it. Based on the graph on screen, you can see that the stock isn't immune to market downturns such as the COVID-19 market crash. However, despite this, the stock still survived this market slowdown and it even managed to survive the 2007 to 2008 financial crisis, showing that out of all BDCs, this one has a great yield as well as a resilient business model. The stock has recently traded consistently over the $19 mark, but it has dropped as low as the mid-18s in the past few months. To find a good buying opportunity may be hard for a company like this, but if the stock ever drops below the $18.50 mark, buying up shares would make for a sound investment. That being said, quote-unquote overpaying for the stock isn't necessarily a bad thing either, as getting the dividend snowball rolling with the stock will be critical to start getting increased income. The only downside to the stock is that it pays quarterly like most companies, but some BDCs and REITs pay monthly. The downside with this is marginal, as quarterly payments don't slow compound growth by that much when compared to monthly, but for investors who want money month in, month out, Ares Capital cannot provide that consistent monthly stream of dividend income. Overall, for high-yielding BDCs though, this is probably one of the best you can pick up. The next stock on my list is not a BDC nor a REIT, it is the Altria Group, ticker MO. The Altria Group is one of the most notable high-paying dividend stocks and it yields just about 9% with recent hikes as well. This stock has a 5-year dividend CAGR of 5.85%, which is great for a company that already yields this much. It is even more impressive when you consider that Altria is a dividend king and has been growing its dividend for over 5 decades. Although the dividend growth isn't expected to be massive, it already has a huge starting yield, making it an attractive dividend stock to income investors. Now, if you didn't know, Altria sells consumer goods, namely tobacco-related products. They own huge brands such as Marlboro within the United States, and because of this, they retain huge amounts of pricing power in their cigarette business. Because of their pricing power, they have managed to get the net profit margin of their company to almost 50%, which is nearly the same as Visa, showing how profitable their cigarettes are. Even as cigarette sales are slowly losing some traction, their ability to get a huge margin on sales keeps revenue high. In addition, Altria still has room to grow with the e-cigarettes and marijuana market. That being said, e-cigarettes have been a big problem for Altria in the past, as their stake in Juul lost them over $10 billion when the FDA banned the product. However, their new acquisition of Enjoy, a new electronic cigarette brand, is different. First of all, unlike Juul, Altria owns Enjoy outright and not a minority stake in the company. This allows Altria to control Enjoy as they please, which is hugely important. In addition, Enjoy's products are the only one of their kind that has already been approved by the FDA, which is the main reason that Altria was so keen to buy in, as that was the entire reason their stake in Juul went sour. The Enjoy part of their business is supposed to start making a difference in the revenue in 2025 and beyond, so it may be smart to wait until then to see if Enjoy fulfills its promises. Either way, at the current time, it does seem like Altria has the right idea of how to grow its business outside of just tobacco. The payout ratio for Ultra with GAAP is 99.74%, which sounds scary, but without GAAP it is 76.77%, meaning there is still room for small growth. This is backed up by the fact that the company says themselves that they want to keep growing their dividend by small increments until at least 2028. Overall, Ultra is a great long-term dividend play that yields high amounts, and I think a good price is anything under $42.50, but paying anywhere below $43.50 I think is still acceptable. The last stock on the list is Main Street Capital Corp, ticker MAIN. Like ARCC, MAIN is a BDC company that is forced to pay out 90% of its earnings as dividends to shareholders. This has resulted in MAIN having a yield of just under 7%. Although it has a much smaller dividend than ARCC, it has one main advantage. It pays monthly. Not only does this allow for compound interest to occur more quickly, but it also makes it so owning shares of Main is akin to owning a rental property. It pays 7% annually, and it also pays every single month, making it a similar feeling to rent checks. In addition, the dividend is largely safe, and the dividend amounts are pretty consistent. Main also is an internally managed BDC, while most other BDCs are externally managed. What this means is that Main Street has employees that are solely focused on Main Street's operation. This is different from externally managed BDCs, which are managed by third parties, which results in higher fees for the BDC because they have to pay for external management. This ultimately allows Main Street to make more money and pay more of it to shareholders through their dividend. As I said earlier, Main is largely similar to Ares Capital. It invests in middle market companies and supplies corporations with debt acquisition and recapitalization solutions. The smallest companies that Main invests in make anywhere in between $10 and $150 million in annual revenue, but Main almost entirely invests in companies that are larger than this. This means that the dividend safety and the safety of Main's balance sheet is relatively good. Although this stock is very good and the monthly dividends are a huge plus, especially people who want the income, I do think that it is slightly beat out by Ares Capital because of the difference in dividend payments. Although 7% versus 10% doesn't sound that major, it really is. And over time, the compound interest will show for it. The growth of these two companies are largely similar as well, meaning Ares Capital is most likely the better investment, but if having monthly checks is that appealing to you, then Main might be your best bet. Anyways guys, let me know what you think about my picks in the comments. I didn't include any REITs such as Realty Income ticker O, so do you think that was a mistake, or do you think that my picks, especially the BDCs, are the better long-term choice? And finally, thank you all for watching this video, and thank you to those who have subscribed. We are now inching closer to 400 subs, which is fantastic. My goal is to hit 1,000 soon, and you guys are all making this possible. Let me know if there's a video you'd like to see me make, and I will see you in the next video. Goodbye.